over the last couple of these weekly updates, I've been saying I would not be surprised to see if we had a pause in the US bull market in equities. Well, that hasn't been the case. Since I spoke to you last week, the S&P 500 is up 1%. That's a pretty darn solid weekly move. And if last night, Tuesday in the US, the S&P 500 closed at an all-time high. What are the reasons, in my view, why the market's going up? I'm going to give you the two big reasons. They're not unique to me. The first one is that the bulls on Wall Street really like the idea of rate cuts. They want to see short-term interest rates lower, and the Fed is going to meet next week, and they're widely expected to cut interest rates by 25 basis points. And right now, actually, expectations are for 2 further 25 basis point rate cuts before the year ends. The other piece of the puzzle is earnings growth. It looks like third quarter earnings are going to be very strong. Right now, FactSet pegs S&P 500 earnings growth to be about 7.6%. That is marginally higher than where they had it pegged at the beginning of the quarter. And to see those estimates go up is kind of notable, because usually the trend is that companies, speaking to the analysts, kind of talk down expectations as we get closer to earnings reporting. And those earnings estimates tend to trend down ahead of actual reporting. So to see them go up a little bit is unusual, and it's positive. On top of it, the 7.6 number is a pretty good number. And when you put in the fact that when companies actually do report, they tend to outperform by quite a bit, well, it does seem very possible that we're going to have the 4th straight quarter of double-digit US earnings growth. So you put together that strong earnings growth with lower interest rates, voila, here we are at an all-time high. And it's not just the US is going up. We have markets around the world are doing very strong. In Europe, since last week, their market, the Euro Stoxx 650, as measured in US dollar returns, is up about 2%. That outperformed the US. What helped them there is that long-term bonds, government bonds, which the yields of those have been going up and creating a little bit of worry in Europe, actually had a pullback over the last week, and that restored some confidence in the equity market, and that's probably why it did so well. Also in the US, over the last week, bond yields also dropped. The 10-year yield dropped. The proximate cause of that was a weak non-farm payroll report on Friday. However, the 10-year yield has not been able to drop below 4%. And if that trend continues, that the 10-year just can't seem to get too much lower, and the Fed continues to lower rates, that means that the US yield curve will continue to get steeper, meaning that the short-term rates will be lower than the medium-term rates, and the medium-term rates will be lower than the long-term rates. What does that mean for investors? Well, when investors see that they're not doing too well when they have their money in cash or money markets or overnight, they're going to seek out the higher yields if they don't want to go into the equity market by buying bonds with medium-term or even long-term maturities. So that sort of thing, which is already a bit of a trend in the market, we expect that to continue. Okay. After that weak labor report, the jobs report that we had on Friday, and the 10-year yield dropped, we saw US mortgage rates drop to their lowest level since October 2023. They're still high compared to where they were like 5 or 6 years ago when they were below 4%, but right now they dropped down to 6.5%. That created a kind of a little bit of a pop-up in the prices of home-related companies in the US. meaning the home builders, but also like Home Depot. As investors expect these lower mortgage rates to try to inject a little bit of life into a U.S. Real estate market, a U.S. residential real estate market, which is really dead with not many transactions going on, and also have been trending lower. According to the Case-Shiller data, the last 4 pieces of monthly data have all been lower, so we have a 4-month trend of lower rates. If you extrapolate that to the present, the U.S. Real estate prices or home prices have been dropping for 6 straight months. I bring that up just to express my view that I don't think we're going to see yields drop low enough to really help that home market. I think the U.S. property market is going to continue to kind of trend downward, maybe not at a very fast pace, but a lower pace. But that also, in a weird way, is good for the equity market, because I think that's got to be taken by the Fed as a sign that inflation is not really a problem, and it's going to encourage them to follow through on those rate cuts that are currently predicted by the futures market for October and December of this year, and we will get 75 basis points of rate cuts this year. Okay, what was the proximate cause for those mortgage rates dropping? Well, on Friday of last week, the Labor Department reported that the U.S. economy during the month of August only produced 22,000 jobs. Expectations for that number weren't too high, but that was lower than expectations, and it means that the job market isn't really creating a lot of jobs in the U.S. And of course, the Fed has a dual mandate, both inflation and full employment. So seeing the job market deteriorate, where it's not really creating new jobs for people entering the workforce, well, that's going just to encourage the Fed. That's another encouragement of the Fed to cut interest rates. The unemployment rate remains relatively low, but it has ticked up to its highest level since 2021. It's now at 4.3%. Okay, besides just looking at that number that came out on Friday of last week, you have to look at it amid the backdrop of that we've had some pretty serious revisions in previous monthly reports that came out this week. Basically between April 2024 and March of this year, revisions reduced the Labor Department came in with revisions which lowered those monthly estimates for that period by 911,000 jobs. Now, what does that mean? It means that the U.S. economy didn't really produce that many jobs last year in 2024, and in 2025, it's got to be almost close to zero job creation. Immediately among Trump supporters, that makes people wonder, were the previous numbers cooked? That's because, obviously Biden was president last year when a lot of those numbers came out, and they were producing good numbers, which makes his presidency look more successful. And then after he lost, of course, the numbers get revised and come out lower under Trump. I don't think that's the case. If you look at the way the numbers are created, the revised numbers are very high numbers that come with a lot of government official filings of corporations to the government. But the monthly numbers come from surveys of corporations. And those numbers have become more volatile, less accurate over time. The Bureau of Labor Statistics probably should have done something about this several years ago, but governments are not very good about being proactive. And so here we have that the monthly numbers are just not that accurate, and the Bureau of Labor Statistics are going to probably have to make changes to their methodologies in order to improve them to make their more valuable numbers. Nevertheless, I think even those inaccurate numbers pretty accurately describes what's been going on. If you look at like sentiment numbers, most of those numbers showed people thought that the US labor market, consumers would say that the job market was pretty darn good up until the beginning of this year. And of course, the jobs figures did start deteriorating. Those incorrect numbers did start deteriorating at the beginning of this year. And so they have mirrored the fact that the US job market wasn't really that bad last year, has become weakened this year. And also the idea that the job market is particularly bad may not be entirely correct, because we do have those weekly unemployment claims numbers, which have remained pretty contained. And those are hard numbers. Those numbers are not inaccurate. So overall, what we have is a jobs market which wasn't as wonderful as expected, but probably wasn't terrible, is deteriorating, and that's going to prompt the Fed probably to cut interest rates 3 times this year. At least as we stand now, that's popular with the equity market. Could anything overturn that scenario? Well, we have 2 pieces of inflation numbers coming out this week. We have the PPI, which comes out later today on Wednesday, and we have the CPI coming out on Thursday. If you remember, last month the PPI was at 0.9 month to month, which was way higher than expected. That was a little bit of a shock to the market, made people wonder, is inflation a bigger problem than we thought? That number is expected to come in at 0.3% again month on month. I think the market will kind of take in stride if there's another miss on either of those numbers, the PPI and the CPI. That's basically because I think because of that labor market number, a 25 basis point cut next week is sort of baked in the cake. And of course, if you get a higher inflation number, expectations for those other cuts later in the year, those expectations will decline. That won't be good for the equity market. But I think the market kind of looks at a bunch of things going on. They say, well, there'll be a lot more data between now and October. We don't have to really focus too much on this one. So what I'm kind of saying is, even if we get a miss on those numbers, I don't think that's going to change things too much. I think the market will take it in stride. The bull market will just continue. Of course, if those numbers are lower than expected, the bulls will love it because it just locks in those further rate cuts. Besides the inflation number, the PPI number coming out later today, we also will have an update from the Atlanta Fed on their GDP Now forecast. The most recent update they had, the Atlanta Fed predicted that third quarter US GDP would grow at a 3% rate. That's a very strong rate. It seems likely that number will come down. But even if it does come down, it's still got to be a solid number. Most economists are predicting that US GDP growth for the full year, 2025, are going to be around 1.8%. That comes on the heels of a very strong 2024, 2.6%. One of the things, if you've been listening to me, you go, well, how do I reconcile that strong US economic growth with the fact that the job market isn't really as strong as we had expected? Very little growth last year, maybe no growth at all this year, the way things are going. Well, the answer is that the US economic growth is being driven by productivity growth. The people who are out there working are producing more economic value than they were last year. That apparently is good for the US stock market. And that may actually be part of the reason that you're seeing US corporate earnings growing at a very strong rate, that you're having strong productivity growth. An obvious thing to point to for that productivity growth is AI, but I'm doubtful that there's been enough AI adaptation thus far to actually have an impact on U.S. productivity. But certainly the optimists out there will say this is something that's got to be a backdrop to the economy over the next several years. So you may have a continued strong or improved U.S. economic growth on the basis of better productivity from AI over the next several years. And if you look at the way U.S. company earnings are growing, it seems entirely possible that that'll show up in stronger U.S. earnings. Another thing that I want to kind of relate to the fact that the job market isn't so strong is consumer spending. One of the things that you can wonder is, well, if the job market's not so strong, why are we getting good retail spending, good consumer spending number? And that's because it appears that the market's pretty bifurcated. The lower end consumers are feeling pretty constrained. Last week I was watching an interview with the CEO in McDonald's. In that interview he said that even spending for breakfast, it seems like McDonald's customers are trying to cut back stuff. And the reason he pointed out breakfast, he said that's usually a pretty resilient thing. I think one of the things hurting McDonald's is the fact that breakfast at McDonald's isn't very cheap anymore. It's a little bit expensive. And so if someone is feeling constrained in his spending, it doesn't mean he's got to skip breakfast. He just knows that he'll save a few bucks if he has his breakfast at home, and that's sort of what's going on. You can see the same sort of thing as that the expense of something is causing people who are cash constrained to cut back in Las Vegas visitor numbers, which are running terrible this year. They're down pretty substantially year on year. And this is really a case where a lot of the analysts are pointing out that a Las Vegas vacation, which used to be considered a relatively cheap vacation, that is if you don't lose a lot of money in the slot machines, is now an expensive vacation. Hotels on the Strip are expensive, meals are expensive, et cetera. And that the visitors, are choosing to kind of give it a miss. So you're seeing the lower end of the consumer cutting back, so that must mean that the higher earners are spending more. Are they really doing that much better in their salaries and incomes? I'm questioning that. I think part of it, is a wealth effect. I think this booming stock market has benefited a lot of people and made them feel more comfortable about their spending. Certainly among retirees, what I read is a lot of retirees who had, at that point, they probably have their maximum amount of money invested in the market as they prepare for retirement. This recent bull market we've had for the last 3 years has made their retirement look a lot more comfortable than what they originally expected, and they're being a little looser of their wallets. This actually comes with something of a risk, because if we see the stock market starts to drop, that wealth effect will work in reverse, and you'll see not only the lower income people being cautious with their spending, but the higher income people being cautious with their spending as well. And that'll have an impact on the economy, it'll have an impact on company earnings. So the market dropping, might actually lead to worse earnings and a worse stock and further drops in the stock market. Anyhow, I don't want to end too much on that negative note. What's really going on now, rate cuts next week. We have inflation data today and tomorrow, which I think won't be so good, but the market will kind of shrug those off, and we can look forward to next month hearing very strong U.S. corporate earnings. Thank you.